conversations. First up, Transport Corporation of India. And revenues were up 9% this quarter. Profits also increased 17% from last year. And Vineet Agarwal, who is the managing director of the company, is joining in right now to discuss the road ahead and, of course, how the quarter panned out. Vineet, good morning. Thank you for joining in. What has happened with the margins for the Seaways business? There has been a very, very sharp improvement, as we see. We've gone up to 37% in this business. Is that level sustainable, or do you see that 28, 29% historical levels are the ones that are the normal ones?
Hi, it's a pleasure to be here. Seaways has seen quite a remarkable jump in the last, in fact, a year or two. With the crisis in the Middle East and other things that are happening, as you know, with geopolitical tensions, the freight rates globally have been rising. And they sort of, come down a bit and then they pick up a little bit. And, there's always been a lot of uncertainty. And when that happens, the capacity from the Indian markets, and as you know, we operate only on the coastal routes of India, that capacity moves away from India and goes outside. And when that happens, the freight rates domestically also go up. So the last quarter has been decent, more in terms of the number of trips that we've done and the fact that the freight rates have remained stable. Fuel prices have come down a little bit. That is the bunker prices specifically for the coastal ships. So all in all, it was a good quarter for the shipping business, and hence we saw decent margins. I do not think they're always sustainable. They've been keeping up this 30-40% range, but I think it should probably stabilize more between the 25 to 35% range.
Okay. Vineet, on the freight business itself, you said freight rates were steady this time around, but we did see margins declining on a YOY basis to 2.4% versus 3%. EBIT was down 17.9% and revenues grew in single digits. When do we see higher growth come by here, and when will we see an EBIT margin expansion?
See, the freight business follows the GDP growth to a great extent and also follows the kind of industrial activity that is happening across the country to a great extent. Industrials are a bit slow, and we've seen that the order books are there, but really the flow has been very less in this last quarter. And we are seeing this trend continuing even in Q2. We know, for example, that the summer has been weak, and that has affected consumer durables, even consumer FMCG sales, as well as things like industrial gases, etc. The things that have done well is agriculture, that the sector has picked up, including the inputs, more on the input side, as well as tractors, etc. So the general weak sentiment has affected that business, and the growth has been subdued. And we are seeing festival stocking started, and we are hoping that this will start picking up in Q2, towards the end of Q2, and then it flows on to Q3 and Q4. But right now, the business is really mirroring what's happening in the economy.
Got that. Vineet, hi. Morning, Rima here. Just some numbers on the guidance. Last time you spoke about a tonnage growth of 7 to 8%, revenue growth of 10 to 12%, and margins improving by 150 to 200 basis points. That was the guidance we have for FY26. Is that intact?
Yes, our expectation is that the next few quarters should start picking up. And, we have to look at the kind of growth that we are seeing in different businesses as well. So one is that our supply chain business is doing reasonably well. We've seen huge amount of growth coming from the warehousing side, for example. Warehousing structure is changing in the country. The demand for warehousing for quick commerce, for example, is increased dramatically. We are doing a lot of that as well. Or for that matter, companies wanting to work with larger companies like us or organized players like us, that's increasing a lot. Cold chain business is increasing, our rail business is increasing. So some of our joint ventures are doing reasonably well. And I think a combination of all of these factors would mean that we should be able to maintain that guidance that we've given at the start of the year.
So 10 to 12% revenues, tonnage growth 7 to 8%, margin improvement 150 to 200 pips.
That's right.
Since you mentioned cold chain, Vineet, how did that fare in this quarter? You mentioned it has picked up. By what quantum did it do so? And what are your targets that you have for this business for the year?
Cold chain is a very interesting business because, what we are seeing is that different kinds of growth sectors. It's a small business for us. It's about 100 crore business, but we grew at about 18-20% in the last quarter. business growth is coming not just from pharmaceuticals and QSRs and the food sector, but we are also seeing growth from things like chemicals, because there are certain types of chemicals that require cold chain now, as well as battery technology. Certain kinds of battery also require an ambient temperature. The ambient temperature in India is not 20 degrees, it's much higher. So you need to maintain certain kinds of products into that kind of ambient temperature. So cold chain in the next few years is going to be a real growth driver from many areas, including in the future, maybe even semiconductors. So yes, we are very bullish about it.
All right. And what about the Capex plans for FY26? What do you have on your radar? Because it was around 275 crores in FY25.
The plan is to spend about 450 crores this year.
And how do you fund that?
The funding is mostly internal. We have enough cash flows coming in. We can take in certain small amount of debt. We have about 250, 280 crores of cash also on our books. And the Capex is going into ships that we placed an order for last year, which will be delivered next year. So some of that Capex, some of into trucks, into warehousing, into equipment related to warehousing, conveyors, etc., and of course into IT systems. So this Capex of 450 is really planned out. We could do more if a second-hand ship is available to us, and that would be another 150 crores.
Very, very quickly, just on quick commerce. I thought last time you spoke, in previous interactions, that you steer clear from quick commerce, e-commerce, because of poor unit economics on delivery, where delivery charges have come down to 4 to 5%. But now you're saying an opportunity is opening up on the warehousing side. Very quickly.
Warehousing is very different from that part, because warehousing is on the fulfillment side. We do the back end, we do consolidation from various suppliers, and then sending the material to the dark stores. The last mile is not something that we do, and as I said, that's where the unit economics don't work for us.
Got that. Thank you very much for that. We'll get into a break. The management of Motherson Sumi Wiring India joins in on the other side. Stay tuned.